After years of building your company, raising multiple funding rounds, and navigating dilution, there's ultimately one question that determines whether it was all worth it, which is how do you actually turn your equity into money? Welcome to the final episode of VC Decoded, where I explain the two main exit strategies that provide liquidity for founders, employers, and investors. There are two primary ways to exit a venture backed company: going through going public through an IPO or being acquired by another company. Let me explain how each path works and what it means for different stakeholders. An IPO or initial public offering is when a company sells shares to the general public for the first time. The company works with investment banks to determine a share price, registers with the SEC, and begins trading on a stock exchange like NASDAQ or NYSE, or in India, BNSE. The IPO process typically takes 6 to 12 months from the initial decision to actual trading. Companies need to meet specific requirements, including revenue thresholds, financial audits, and governance standards. When a company goes public, existing shareholders, which are founders, employees, and VCs, receive stock that theoretically has immediate value. However, there's usually a lockup period of about 90 to 180 days during which insiders cannot sell their shares. An acquisition happens when another company purchases your startup entirely. The acquiring company pays either cash, stock in their company, or a combination of both. The timeline for acquisitions is typically shorter, ranging from 3 to 6 months from initial offer to closing. Let me illustrate the difference with a concrete hypothetical example. Tech Corp, let's say Tech Corp is an 8-year-old company with two exit opportunities. They can either go public at a $2 billion valuation or accept a $1.8 billion acquisition offer from Microsoft. At first glance, the IPO seems like the obvious choice since it's a higher valuation, but the reality is more complex. With the IPO route, founders and employees receive stock worth $2 billion on paper, but they face several restrictions. There's a 6-month lock in period before they can sell. The stock price will fluctuate basis market conditions and company performance. The company must also bear ongoing public company costs, including compliance, reporting, and governance requirements that can cost several $1 million annually. With the acquisition route, shareholders receive immediate liquidity. The $1.8 billion is typically paid at closing, though some portion might be held in escrow or tied to performance milestones. There's integration risk as the acquiring company might change or discontinue the product. Key employees are often required to stay for 2 to 3 years as part of the deal structure. The distribution of proceeds depends heavily on the liquidation preferences and ownership structure established in previous funding rounds. In an IPO scenario with $2 billion valuation, the distribution might look like this. Founders own approximately 25%, worth $500 million, but subject to lock in restrictions. Employees collectively own about 15%, worth about $300 million, but individually, amounts depend on vesting schedules and option strike prices. VCs own roughly 60%, worth about $1.2 billion, and they typically have more flexibility to sell after the lock in period. In an acquisition scenario with $1.8 billion, the liquidation preferences from previous funding rounds get paid first. After that, the remaining proceeds are distributed according to ownership percentages. The cash versus stock component affects immediate liquidity for shareholders. The choice between IPO and acquisition involves several strategic considerations. Companies typically choose to go public when they have strong, predictable revenue growth, a large addressable market ahead of them, a management team that wants to remain independent, and favorable market conditions for their own sector. Companies typically choose acquisition when there are meaningful synergies with the acquiring company, the team wants immediate liquidity, market timing is uncertain, or integration would significantly enhance their competitive position. Here's an important insight: the highest valuation doesn't always mean most money in founders' pockets. A $1.5 billion acquisition might deliver more actual cash to founders than a $2.5 billion IPO, depending on the terms, market conditions, and the timing. The choice of exit strategy should influence major decisions throughout the company's life. Your market position, team building, fundraising approach, and even product development should align with your intended exit path. Some companies build specifically to be acquired by larger players in their industry. Others focus on creating standalone businesses that can thrive as public companies. Both paths have created tremendous wealth for entrepreneurs, employees, and investors. The key is understanding which path aligns with your goals, market conditions, and company characteristics. Now, that concludes our VC Decoded series. We've covered the complete journey from understanding what venture capital is to identifying the money behind VCs to navigating funding stages, valuations, dilution, term sheets, and finally today exits. Understanding these concepts help entrepreneurs make better decisions, employees evaluate equity compensation, and anyone interested in the startup ecosystem understand how venture capital actually works. Thanks for being in this journey with me. Follow me for some more insights that I'm going to throw in the coming days. Thank you.